Today's session on agriculture, finance conditions, and outlook sets the stage on where the industry is currently and allows us to consider alternatives as we discuss topics throughout the week. After reaching a peak in 2012 of $153 billion, adjusted for inflation, U.S. net cash farm income fell to $102 billion in 2016 and has gradually recovered since then. Joining us today is our first speaker for the 2020 Agriculture Policy and Outlook Conference covering the Farm Income and Finance Outlook is Dr. Ani Katchova. Dr. Katchova is an associate professor and farm income enhancement chair in the Department of Agriculture, Environmental, and Development Economics at Ohio State University. She chairs the Farm Income Enhancement Program and conducts research and outreach on agriculture economic issues. Her research areas include agriculture finance, agribusiness management and marketing, and applied econometrics. Of all her titles, my favorite is that she holds the honorary title of Kentucky Colonel from her time at the University of Kentucky. She is the founder and instructor of Econometrics Academy, offering worldwide education on econometrics. She holds a PhD from The Ohio State University and was a faculty member at the University of Illinois and the University of Kentucky prior to her returning to her alma mater. At this time, it is my honor to turn the program over to my colleague, Ani Katchova. Welcome, Dr. Katchova, and thank you for being here today.
Hello, everyone. I hope you can see me and see my shared screen as well. I'm very glad to be here today and be the opening speaker for our Ag Policy and Outlook Conference for this year. So today I will speak about farm income and finance outlook. I will cover 4 themes throughout my presentation. The first one would be to discuss U.S. net farm income and net cash income, which are forecast to increase for year 2020 for a 4th consecutive year. Then I will go over the growth of farm income and break it down for different components and show that this is mainly driven by higher government payments with lower expected livestock receipts. Then I will turn into more long-term projections for farm income and prices, which everyone is thinking about, which show a tremendous amount of stability after 2 or 3 years. And I will conclude with farm financial straits, and particularly the ag loan delinquency rates and the bankruptcy rates, which have experienced some recent upticks, but have remained relatively low throughout the last few years. So let's start with the farm income estimates and forecasts that USDA, the Economic Research Service, puts together. This is an update as of September, and we see that both the U.S. net cash income and net farm income are forecast to increase this year as well. If realized, these values would represent the 4th consecutive year of increases of net farm income and net cash income. If we compare the US estimates to Ohio estimates, we actually see that very surprisingly last year in Ohio, we had a lower net cash income and net farm income after increasing for 2 consecutive years. And typically, Ohio's farm income has been about 2.4 to 2.5% of the US farm income, but it has had a higher volatility over the last decade. So that's why we saw a little bit of a decrease in farm incomes here in Ohio last year. Now, the USDA does not give an official forecast for year 2020 for Ohio, but if we continue the same trend as the US, we would probably expect to see an increase in farm incomes for this year as well. But we did not see that last year. So now, comparing the farm income over the last 70 years in terms of real terms, what we can see here is that the U.S. farm income has actually increased and it's currently above its long-term average, whereas in Ohio we saw a decrease below the long-term trend as it was as of last year. Now, there's a question of the accuracy of these farm income forecasts, and I have conducted two studies that were published this year. The first one was published with Todd Keithy, our next speaker, and the second one as well. And the second study was also joined with my PhD student, Sid Bora. And what we found in these studies is that if we look carefully into the accuracy of these farm income forecasts, we're finding that the first forecast that comes out in February consistently underpredicts the final estimate for the year. So there's an underprediction bias. But with our consequent study, what we also found is that this bias is potentially due to high cost associated with overpredicting of the farm income, yet these forecasts are still rational. So again, we found that in the beginning forecast, the February forecast underpredicts farm income by about 10%, yet as the year rolls on, that bias tends to go down and the forecasts tend to be more accurate over time. Now, turning into the components of farm income, let's first look at the crop and livestock receipts as a whole. We are expecting to see a little bit of an increase in cash receipts for crops, up to $197 billion, while the animal product receipts are expected to decline to $162 billion for year 2020. If we break these down by different commodities, we can see that we are actually expecting to see decline in the cash receipts for across several commodities this year, including cattle and calves and corn. Particularly the crops and livestock that are important in Ohio, we can see that many of the receipts for several commodities decreased as of year 2019, particularly for corn and for soybeans and wheat. And there were some increases as well last year. Now, everyone is talking about government payments this year. And if we look over the last 20 years, government payments have increased substantially for the US. They're expected to increase by 65.7% in 2020 and reach $37.2 billion. This will be up from $22.4 billion in 2019. If we plot the same total direct government payments for Ohio, we can see that as of last year, those were $0.7 billion. And again, as you can see, Ohio follows similar trends, but not identical trends to the US. So perhaps we would see also increase in total direct government payments for this year in Ohio as well. Now, breaking down the different components from last year to this year, what increased and what decreased. If we start with net farm income of $83.7 billion as of 2019, what really decreased this year is livestock receipts by $14.3 billion. And what increased is crop inventory change and and government payments as well. And this is the expected net farm income as of the end of this year of $102.7 billion. So again, we see that increases in government payments and crop inventory change would drive the overall increases in net farm income. Now, everyone is asking about the long term, and the USDA puts out baseline projections that are 10 years ahead. Now, these projections were put out as of February of this year, so this was before the pandemic. And as of that time, the projections are showing expected increases in net cash income in 2021 and then decreases for 2022, and the opposite trend for farm income. So as we were looking at these projections going into the future, they are not forecasts in terms of this is not what is expected to happen, but they're conditional scenarios based on the current conditions. Yet still, one trend that we noticed is that these projections are becoming very flat several years into the future. So we actually looked a little bit more carefully into those trends. So here, what we have plotted is these are the actual values for net farm incomes, the red line. And the purple lines here that we see are the projections in each of these years. And as you can see, there's some information in the first few years as these projections are coming out, but then they flatten. And the same is true for the baseline projections that I showed you on the previous slide, as they flatten over time. So in our current working paper, what we are finding is that these projections remain informative for up to 2 or 3 years ahead in the future, and then they become uninformative after that. So basically, they're a flatline prediction after 2 or 3 years in the future. So if we're looking at crop prices, and here I'm showing you the WASDE forecasts as of October, we're expecting to see corn price to increase and also soybean price to increase for the marketing year of 20 to 21. And if we actually look at these baseline projections and the actual marketing year averages, we actually see exactly the same trends as we're trying to project well into the future, 10 years ahead. And this is that corn price is projected to increase to 360 in the current marketing year and then remain flat at 3.55 after the 24-25 marketing year. So look at testing these projections using several statistical tests, we're finding that these crop price projections are also not informative 2 years and more out. So what we know right now is that we have fairly good and accurate projections as of the end of this year, and we have probably some reliability in a projection, maybe 1 or 2 years ahead, and then after that, the informational content of these projections is going down. Now, completely shifting gears, I wanted to talk about the delinquency rates and bankruptcy rates that we see recently. So, agricultural loan delinquency rates for Ohio and the US are plotted here. We see that there were some substantial increases in the 2010, but as of now, we see that we're at a general about average trend here. And we see that the US ag loan delinquency rates are increasing, whereas very surprisingly, Ohio shows quite a bit of resiliency and is showing slight declines, particularly in the last year. Now, looking more spatially how these ag loan delinquency rates are distributed across the country, the black dots are where the concentration and the volumes of agricultural loans are currently in the US. As we can see, there's a lot of ag loans in the Midwest. However, if we look at the shades of each of the states, they show the delinquency rates. And what we're noticing here is that actually the delinquency rates are not particularly high in the Midwest and in Ohio. So we're noticing that the ag delinquency rates are remaining fairly low at 2.25 during the last 4 quarters, but that increased from 2.05 in the previous year. Now, zooming in a little bit more on Ohio to show you the ag loan delinquency rates, what we're finding here is that the Ohio ag loan delinquency rate, again, was 1.49% in the last 4 quarters, which actually was below the US average. And very surprisingly, Ohio ag delinquency rates decreased from the 1.59% in the previous 12 months. Despite that, we see some pockets of increased delinquency rates across Ohio. Now, let me show you the Chapter 12 farm bankruptcy trends. Again, we see right up in them in year 2010. And these trends are actually amazingly similar to the delinquency rates. As we very well know, the bankruptcy are actually a lagging indicator of financial stress, whereas we can think of the delinquencies as a leading indicator. And we're seeing here that we have had about 150 Chapter 12 filings in the US as of the third quarter of this year. So we've had some recent upticks, but generally the bankruptcy have remained relatively low in recent years. Now, looking again spatially across the US, where the most of the Chapter 12 bankruptcies are filed, this data has the latest third quarter updated, and they were 580 Chapter 12 bankruptcies from October of 2019 to September of 2020, which is just slightly lower than the previous 12 months. And in Ohio, there were exactly 12 Chapter 12 filings from October of last year to September of this year. So now, in terms of bankruptcy rates, we see that the Ohio farm bankruptcy rate of 1.54 Chapter 12 bankruptcy filings per 10,000 farms has remained about the same as last year. So we do not see a lot of increased number of bankruptcies. And typically, the Ohio rate has been about half of the US bankruptcy rate, which was 2.78, and it has remained similar to what it was in the 12 months prior. So, to summarize the farm income and finance outlook topics that I talked about today, we expect to see farm incomes growing for the fourth consecutive year. And the conclusion is that the farm income shows some resiliency, though, during very challenging times and uncertainty during the pandemic. The government payments that we expect to see from the market facilitation program and CFAP2 due to the trade wars and the pandemic have definitely helped to boost and stabilize farm incomes for 2020. If we look into long-term projections of farm income and crop prices, they show slight increases or decreases for the next 2 or 3 years and then flatten or become not as informative after 2 or 3 years. I have also shown you that farmers are experiencing some financial stress with recent upticks, but still relatively low ag delinquency rates and bankruptcy rates. And the long-term projections would raise some concern if these conditions persist. The severity of these concerns, of course, would depend on the continuation of the ad hoc government aid, which are meant to stabilize farm incomes and keep the ag loan delinquency rates and farm bankruptcies low. So thank you very much for attending today.
Thank you, Dr. Katchova. We really appreciate that. We did have one question come in that I think we can get you to answer here or follow up at a later time as well. But one of the attendees asked, are the Wisconsin bankruptcies related to dairy farming?
Right. So this is a very good question of what the bankruptcies are related to which sector. As we are looking at the U.S. courts data, we actually do not have a precise commodity description of the farmers and ranchers. So we cannot exactly tell what these are due to. However, given the large concentration of dairy in Wisconsin, it is very likely that we see these bankruptcies being high in Wisconsin, particularly due to large prevalence of the dairy sector there.
All righty, thank you.